Today on Go Ahead Ask, if you're in the middle of a 1031 exchange transaction, you probably know the hardest and most stressful part of a 1031 exchange is locating and identifying replacement property during your 45-day identification period. You're asking questions like, what should you buy? Where should you buy? What are your investment options? Let's unravel that today on Go Ahead and Ask.
Building wealth in real estate? Let the Exeter Group take the mystery out of how it's done on Go Ahead Ask.
Welcome to Go Ahead Ask podcast by the Exeter Group, where we unravel the mystery of investment real estate. Our objective is to provide investors with better quality information so that they can make better informed investment decisions. I'm one of your hosts today, Bill Exeter, CEO of Exeter 1031 Exchange Services, along with Lauren Speidel, Regional Manager with Exeter 1031 Exchange. The Exeter Group of companies includes Exeter 1031 Exchange Services. We act as a qualified intermediary. We cover all 50 states, all types of 1031 exchanges. It also includes the Exeter Trust Company. Exeter Trust serves as custodian for self-directed IRAs and individual 401k plans, trustee of title holding trust or land trusts, and escrow agent for specialty holding escrows. On Go Ahead Ask, we always encourage your questions and your topics. So go ahead and submit your questions and topics to ask@exetercode.com, or you can call us at area code 619-239-3091. If you love Go Ahead Ask, please like it, subscribe to it, share it, and comment on it. We will respond to all questions. Today's episode is entitled Unraveling the Mystery of the Delaware Statutory Trust. One of the biggest challenges that investors face when doing a 1031 exchange, especially in today's fast-paced real estate market, is locating and identifying replacement property, especially during that 45-day identification period, and then actually acquiring and closing on the replacement property during the 180-day period. And questions come up all the time of where should I buy? What type of property should I buy? What are the options that I might be able to consider? We're going to unravel that today on Go Ahead and Ask. And Lauren, why don't you go ahead and introduce our guest today?
We're very excited to have Rob Johnson with Realized as our guest today. In his role as head of wealth management for Realized, Rob is responsible for the client's investment property wealth management experience and the Realized advisor team. Rob works across the industry to increase awareness of 1031 exchanges, which we love to hear, and Delaware Statutory Trusts. In Rob's 20 plus years in the financial services industry, he has held senior leadership positions in some of the largest advisory firms, overseeing platform development, investment research, product due diligence, and has been a major contributor to the growth of all of his past and present organizations.
Welcome, Rob. It's so good to have you on a podcast today.
Thank you so much, Bill. Thank you, Lauren. Thank you, Exeter. Very happy to be here. Excited to have this conversation.
Looking forward to it. So now let's unravel the mystery of Delaware Statutory Trust.
Certainly. So while a lot of clients, I believe, look at it as a mystery, what my team and what our platform does is help clients unravel that, make it completely transparent, and at the end of the day, provide a custom solution that addresses directly their 1031 needs at the point of the exchange and going forward over the long term. Realized is an end-to-end platform that allows clients underneath 1031 exchange to utilize Delaware Statutory Trust in a custom portfolio that, again, provides them with a long-term investment solution and helps them get from one end of their 1031 exchange journey to the other.
Now, Rob, can you dive into what is a Delaware Statutory Trust? Because that's, of course, just kind of the surface of this podcast today.
Yeah, the Delaware Statutory Trust, or DST, the acronym is, as we refer to it, because it gets kind of tiring saying Delaware Statutory Trust all the time. But what it is it is a real estate investment vehicle. So the IRS, when it looks at a DST, says it can be used as a suitable replacement property in support of a 1031 exchange, and the underlying asset in the DST is real estate. However, the wrapper is a security. So me and my team are all licensed with FINRA. You have to be a registered representative or a registered investment advisor to utilize the Delaware Statutory Trust vehicles with clients. We have a broker dealer that's overseen by the Securities and Exchange Commission and FINRA, but ultimately a Delaware Statutory Trust is a vehicle that allows a client to choose, to select the real estate region or sector or multiple real estate properties within that wrapper that they feel most accurately meets their long-term investment objectives, needs, and guidelines.
And what are some of the reasons that an investor would look at a Delaware Statutory Trust?
Yeah, it's a great question. So, when we work with clients, frequently we have situations where a client is in search of direct real estate as their replacement property. So they're doing a like to like, they're going from, raw land to an apartment building. However, they aren't completely sure that the property that they've selected will definitively execute. So sometimes we'll work with clients who need a backup solution. The DST works exceptionally well as a backup solution. In that manner, we kind of refer to it as insurance, because if the direct property falls through, you can always rely on a DST. It can be used for an exact dollar amount of investment. So it can be a complete fill for a 1031 exchange obligation or meeting that replacement value. We can also come in and provide a DST in a solution where the property that's sold was sold for $1 million. The replacement property is $700,000, but with that delta or that gap to the full replacement value, a DST also comes in handy. You could do a $300,000 DST position, and that meets that $1 million replacement value. And ultimately, when a client comes to us and has gotten to the point in their life, and in some cases, it's towards retirement or it's in retirement years, they are moving from an accumulation stage to a distribution phase, and they no longer want the obligations or the responsibility for managing a direct property. A DST is also a great solution. It is a passive investment. It allows them to satisfy their 1031 exchange, so it avoids any tax situations where they are being impacted by the sale of a property underneath the what we refer to as the tax impact, and allows them to diversify. So in many cases, clients have a concentrated asset, that direct real estate property. What we're looking to do is help them diversify out to multiple investment properties. We have DST that have a portfolio of properties underneath. We have DST that have single properties. And again, you may be a client in one state and you have a tremendous amount of direct real estate assets, and you're thinking to yourself, in the next stage or phase of my real estate management, I want to reduce the concentration to any one area and increase my allocation to tax-free states or states in the Midwest or the Sun Belt, where we're seeing population growth, some states that have no state taxes, and also move from one sector, such as a multifamily, if that's your current investment property, to other sectors, such as industrial or medical office, self-storage. We can essentially put together a portfolio of real estate using DST that are highly diversified, have different maturities, are in different locations or regions throughout the country. And in that manner, we're actually managing an investment property wealth portfolio for the client.
You just mentioned a number of benefits to the DST, and that's kind of where we were leading, is what are the benefits and the risks of the exchange. Before we jump into the risks, are there any additional benefits that come up quite a bit? Maybe your top 3 or 4 benefits that you just want to highlight here, or if you want to jump right into risks, we can do that as well.
No, I would say when clients in the earlier stages of vetting whether or not this is a good solution for them and a good fit for their strategy, ultimately it's the passive nature of the DST. It's the ability to shed the landlord duties, a lot of the risks that come with a concentrated position in any asset. You could even have a concentrated position in DST that, again, we look to alleviate through diversification. So if you have a duplex that you're selling and you've done exceptionally well with appreciation over the years, and you want to take that appreciation and the value of that relinquished property and migrate that into a DST or a number of DSTs. So while you're selling a duplex that could be several $100,000 or even several million, you're moving into an investment property in some cases, which is 10, 15, up to $200 million in the portfolio. So it, in its own regard, is highly diversified.
And with that, we're going to take a quick break for a message from our sponsor. This episode is sponsored by our sister company, Exeter Trust Company. Did you know that all individual retirement accounts are self-directed IRAs? It's because you choose where to put them. You choose whether to put your self-directed IRA at a bank or at a securities or brokerage firm or a life insurance company. So that makes it self-directed. But did you also know that all IRA custodians are not created equal? Most IRA custodians, like the banks, the securities firms, and the life insurance companies, limit you to publicly traded investments such as stocks and bonds and mutual funds. But some IRA custodians, like Exeter Trust Company, allow investors to invest their IRA funds in other alternative assets such as real estate. Investors can acquire real estate, mortgages, deeds of trust, or tax lien certificates inside the IRA as an investment inside the IRA. To learn more, call Exeter Trust Company at area code 307-222-8750 or visit them on the internet at exetertrustcompany.net. And we're back. And now let's continue to expand upon Delaware Statutory Trusts. And just before we went to the break, we were talking about the benefits and the risks of Delaware Statutory Trusts. So Rob, why don't you go back and maybe start diving into the risk category for DSTs?
That's a great question, and something that we spend a lot of time helping clients to understand. It has to be a good solution and a good fit across the board. So when we look at the risks, invariably, any investment has risk. Nothing out there in the investment spectrum is devoid of risks. There's always the possibility, even in direct real estate, that the property doesn't appreciate or do as well as you had hoped or expected over time. So, of course, there are, with a DST, risks that the individual property or properties in the Delaware Statutory Trust wrapper will have a distribution cut or a stoppage based on a number of factors. We saw, for example, during COVID, in certain sectors such as hospitality, that people were not traveling, no one was staying in hotels. When there isn't a generation of income to pass through to investors, of course, that's going to impact them from a income generation standpoint. So that is certainly a risk. One of the things that we point out to clients consistently is that DST are considered illiquid. So what does that mean? It means that even though it is an investment, there's no large exchange. You can't take your DST to the New York or American Stock Exchange and tender your shares in the open market. Once you invest in a DST, you are in there for the duration of the project. And that's why it's important you select the right sponsor who's putting the project together, a sponsor who understands the very important stages of real estate that every real estate investor knows: the acquisition, the management, and the disposition. Those are very important stages. If you get one wrong, it'll impact the investment. So the risks around illiquidity is certainly something we make sure our clients are aware of, but not unlike what someone would have with their direct real estate. Again, you can't go to an open market and sell it at any point in time. There is a control issue for a lot of real estate owners, and we completely understand that. They acquire and maintain their properties for decades. And in some cases, the real estate may have been passed down from generation to generation. And they're making use of the great benefits that the 1031 exchange provides by not letting that investment be devastated by taxes. However, when they migrate into a DST portfolio or even a single DST, they are not in control of deciding when to exit the property. And again, that goes back to the importance of selecting a sponsor. That's what me and my team here at Realize spend a lot of time doing for our clients, is vetting the sponsors, vetting the projects out in the marketplace where open architecture and non-proprietary. What that means is we want to review everything that we can get our hands on, develop an opinion of those solutions of that sponsor. We don't approve everything that we see, but we feel that if we can evaluate the space in its entirety, we're going to understand the trends and ultimately the solutions that we put in a client's portfolio, the way that they should be vetted and evaluated. But going back to the control issues for clients, they have to understand that when they conduct a 1031 and they take their proceeds and invest in multiple solutions, they're also putting the trust and faith in that sponsor who's managing the project to know when to execute, dispose of the property, understand the market cycle, the sector that they're in, the region that they're in, to generate the best possible return for the clients. So personal control comes up a lot, illiquidity of the issuance. And, one of the items that we often hear about is leverage in DST. So clients, over years, maybe they've paid off their mortgage completely, and they're at a point where they don't need to match any debt requirements in the 1031 exchange. And they say, well, should I be using a replacement property in a DST fashion that has debt, does not have debt? And again, it goes back to the individual planning exercise we do with clients, whether or not they want to take on any debt in the projects. From a tax vantage point, there are some benefits when someone's able to offset income utilizing the debt service going to the underlying DST or project. But in other instances, and again, this comes up, if you're paying any component of debt service, it's income that isn't always being generated directly to the investors. So again, we do it in the construct of a planning exercise, and we may choose some DST that have leverage, some that do not. But ultimately, we want to put the client-centric approach in the forefront of the entire process, and we'll build that portfolio based on what the best needs and long-term objectives are for the client.
I'm glad you brought that up. We have a lot of clients that'll talk to us about that exact topic. If I'm selling an asset and it's all paid for, it's free and clear. And a lot of times people don't warn them that, if you go into a regular DST that has a regular leverage of 50, 55% or what have you, you're almost slightly more than doubling the actual amount of asset you're buying, which means on the back end, when it goes full cycle, you've got to replace that entire amount. And depending on their situation in their life, they may not be able to or may not want to. So that's a great point to raise, that they may want to look at just all cash DSTs at that point and not increasing the debt. Or if they increase the debt, then of course they leverage up and it could be even better. But that is something to look at.
Yeah, and again, we will evaluate the longer term benefits and challenges of utilizing a DST portfolio. So exactly to your point, at the stage or phase where the sponsor decides to sell the property and they dispose, put the proceeds back to the client, are they going to be in a position where they want to go back to direct real estate? Are they going to select another DST and continue to roll over those assets? In the DST structure, being able to utilize the leverage or the debt that's specific to the project is something that our clients really appreciate. And I'll tell you why. They're removing debt from their balance sheet. They're not putting themselves in a situation or position where they individually have to go and get a mortgage in the replacement of that property. And they're able to utilize some very, very advantageous financing that large commercial real estate entities or our sponsors will put on their projects directly. So they can use the leverage to benefit their like-to-like and their replacement value. And of course, they don't have to make any payments directly to any credit facility or any bank, any loan directly. It's all done through the project. So it's a very turnkey solution. If they've made the decision to continue to roll in the future and they don't want to go back to direct real estate, it's really taken care of for them. So they do appreciate that. But Bill, you bring up a great point. Knowing what your future debt position may be or could be at the exit of the project is a very important element that needs to be considered, not at that time, but before you enter into the DST directly.
And you mentioned the underwriting process, and it doesn't, the debt doesn't affect them individually. I think that's a great point too. We'll have clients who sell, they're in the middle of an exchange, and all of a sudden they find out they can't qualify for financing. Whether it be they don't have earned income, they're self-employed, they're retired, or whatever the issue might be. And with a DST, they don't have to go through the underwriting process. They don't have to get approved. So that can also be a great solution when they have that, oops, I don't qualify for the financing issue.
Yeah, no, that's a great point. And I think what we all realized after last year and COVID is that the unexpected will happen. And from time to time, we have clients who come to us and they've been provided with a great opportunity to sell their property. It's not at the end of what their preferred or anticipated holding period was, and they're still at a very high leverage point or a high amount of loan to value in their relinquished property. So they need to cover some higher debt or leverage amounts. And we have DST that are designed specifically for that solution. So even if you are well above the 50, let's say you're in the 70 or 80% leverage or loan to value on your relinquished property, we have DSTs that will meet those needs, and you can use that debt easily in the DST that we have available, or position a few DST, one with a higher leverage point, and we can customize or calibrate the exact debt level for the clients. So it's invariably a sigh of relief for clients when they come to us and they don't think that this exists, or they don't think they have options, and they're confronted with the impact of those taxes, but we're able to put together a solution that addresses their needs, and not just addresses it, but again, is a good path and plan for going forward over a longer time period. We haven't talked about this, but the DST holding period on average is 5 to 7 years. So we have DSTs, of course, that will go longer, that will go shorter, and we will try and match the duration of the portfolio to what the client wants and needs. If a client says, I don't want to touch this anytime soon, I'm done with doing a 1031, there are solutions that go out 7 to 10 years or beyond. We also have some really great solutions that are coming into the space now that start as Delaware Statutory Trust, but end up in an umbrella partnership real estate investment trust or UPREIT. Very popular solutions that are being used across the industry in a planning construct. So we're very pleased to be able to give a lot of solutions to clients, give them that optionality. We talked earlier about that loss of control. But what we're able to do now is put together a custom portfolio, which actually empowers them and gives them a lot of solutions and optionality in year 3, 4, 5, 7, 8, and beyond. And that's what it's about. When you make that transition from managing your real estate to utilizing a DST portfolio, you shouldn't necessarily have your options reduced. You should just have a whole new set of options that blends with your custom strategy going forward.
So the DST can certainly help with loan issues, matching the leverage that you need to match. I know earlier you mentioned that it can be used for backup and replacement property identification or remaining cash that you have. If you could just dive into that a bit more, maybe give us an example of how one of your clients were able to successfully execute a fully tax-deferred exchange by using, an actual asset that they're going to manage, and then also a DST?
That's a great question. And again, it's the optionality, and this happens frequently. We have clients who come to us that have identified a great direct replacement property. And we will, in fact, do an analysis and do a planning exercise where we take into account where they are, where they want to get to, blending a direct property based on what region or sector it's in, what the anticipated distributions are on an annual basis, what their planned hold period would be, and blend that with a DST that has one or several underlying properties. So it helps them from a diversification standpoint. If you were considering going from one property to just one other property, 1-to-1 ratio, and while there has some definite benefits from the client perspective in continuing to be in that control position on that direct property, again, there are things that happen. And again, COVID, an environment where we may see a lot of tax impacts in the future. We may see changes in regulatory, environment as it relates to the benefits of holding real estate. Having a diversified portfolio of properties in a different sector or a different region, maybe in a state that has no taxes, gives the client some additional benefit longer term and the ability to pivot. So if in fact they like direct property and they had to use the DST as a backup or a fallback because they had selected 2 direct properties and one fell through, they still have the ability to take those proceeds whenever the deal matures, whenever the offering goes full cycle, and take those proceeds and go back to direct real estate in the future. So the DST can, in some cases, be used as a temporary outlet or a temporary, holding vehicle for a 1031 exchange, understanding, of course, that it is a long-term investment and it is illiquid. But when we look at the holding period for most real estate that 1031 exchange investors are focused on or interested in, it's going to be greater than 2 years. Just by the virtue and nature of a 1031. The average holding period for the DST, though, as I said earlier, is 5 to 7 years.
And going back to the beginning, we kind of touched upon the structure where this is obviously real estate. It's either one or it's a portfolio of properties. And then it's in this trust wrapper, which is sold as a security. So one of the questions we get a lot from clients is, who can we buy this through? So maybe you can touch upon that and the fact that it requires a securities license to actually sell these.
Yeah, that's a great point. So while you are selling real estate through a 1031 exchange, the DST is a security. It is going to be something that when you're working with an advisor or a registered investment advisor, registered rep, they have to be either licensed with FINRA, affiliated or appointed with a broker-dealer or registered investment advisor, because they are securities. And just like any security, it's something that has a level of suitability, compliance, oversight, and a duty to the client to ensure that it is a good fit based on what their long-term objectives and investment needs are. So a Delaware Statutory Trust is kind of a hybrid in a sense. You're seeing it in a security wrapper, but the underlying asset is real estate. You're benefiting, of course, through the 1031 exchange by selling a direct real estate asset and migrating into an investment that has that direct real estate property underneath. And it could be one or several properties. We have DST that have a portfolio of properties underneath. So you may end up being invested in anywhere from 11 to 18 properties throughout multiple states. But going back to your question, Bill, it is a security. You have to be either with a registered investment advisor or licensed with a broker-dealer in FINRA to offer these to clients.
I know earlier in the podcast, it was discussed on the types of clients that you usually see that invest into DSTs. And I know on our side, we see many different types of investors. We see investors that are just starting to build their portfolio and like the control that they have. So going into something a bit more passive, again, might be a bit of a struggle for them. We also see much more seasoned investors who have already built their portfolio, and maybe they're nearing retirement and they just don't want to actively manage real estate anymore. So on your side, what do you typically see as a typical client?
That's a great question, Lauren. And it has definitely evolved and morphed over the past decade. So traditionally, the DST solution was used to a great degree by individuals that were at or nearing retirement. They had migrated from an accumulation stage into a distribution stage. They no longer wanted to devote the amount of time and commitment to managing properties. They could utilize the 1031, take the proceeds from their sale, not have it be impacted by taxes, move it over directly to the DST in a custom manner, meeting whatever leverage amounts they required, a diversified plan with different regions, different locations, different sectors being used throughout the country. So that was what we saw traditionally. As the DST market and the usage of DST has grown substantially over the past decade, and now it's a solution that has great transparency. It's supported by some of the largest commercial real estate entities in the United States. We're seeing a lot of clients who look at it as a solution right next to direct property as an option. And that spans, regardless of what age or life stage they're in. We're seeing clients now who have inherited property or are looking to diversify their real estate portfolio, just like they would diversify other accounts that they have, whether it be a qualified account, a Roth, IRA, 401k, or in this case, putting together a portfolio of diversified DST that address their investment property wealth management needs. So the client who we used to see over and over has now morphed into different holding periods, different strategies for a wide array of clients. And the planning component of that has also evolved. DSTs aren't necessarily something that has an unclear exit duration or time period. The sponsors at this point are very transparent, or as transparent as they can be, with respect to what their hold period is. So clients have more of an option to do planning upon which they can think, well, if this asset comes due in the 5 to 7 year range, or 7 to 10 year range, how would I take those assets and redeploy them, whether it's going back to direct real estate or continuing to do that in a DST fashion, or they may decide to split the assets. We have clients in this market environment that can't find what they would consider a suitable replacement. So they're either left with the option to not sell at all, or coming to us and saying, I would like to have a replacement property for meeting my 1031 exchange needs, timeframes, and guidelines, but I'm just not finding it in a direct market because, again, the great market that they're selling out of is in many cases the same strong, vibrant, highly valued market that they're buying into.
We've kind of focused on DSTs combined with a 1031 exchange. So I'm going to go a little bit off the beaten path, which is, can an investor who's not going through a 1031 exchange use personal out-of-pocket funds to invest in a DST? And if they do, whether it's a 1031 or just out-of-pocket cash, are there minimum investments that they have to be worried about or at least pay attention to?
That's a great question. And again, with the evolution of the DST marketplace and environment, several investors who are looking to get exposure to an asset class as great as real estate, one in many cases that is non-correlated to the overall stock market or bond market, are taking a look at real estate as a non-correlated component in their overall financial plan. So we have a number of investors who come to us and want to invest in a DST through a non-1031 exchange. We do that, work with them. There are additional elements that have to be considered and should be considered when doing that. Invariably, we have clients obviously going through a 1031 exchange. When you don't have that component to consider, you have to do, I would argue, an additional layer of review to understand what it means to go into an illiquid investment with a bucket of assets that isn't tied up currently in an illiquid investment like direct real estate. So we spend a lot of time with those clients making sure they understand the illiquid nature of a DST. It's not as if you can get in and get out. That's very important for them to understand. DST are compared frequently to REITs or real estate investment trusts, which could be public or private, and the variations on what types of liquidity are available in those vehicles varies. So we have to be very clear with the client. But we have a number of clients who are interested in buying not just a newly offered DST, but a secondary DST. So for our clients who come back to us and have the opportunity to invest in a direct real estate property sooner than they probably had anticipated, they want to exit or 1031 out of that DST. The options available to them are pretty much non-existent. That's why Realized as a platform has created a secondary market for our clients' DST. It allows them to take a portion or their entire position, put it on the marketplace, and offer that to other clients who are interested in using a DST with a potentially shorter time horizon or holding period. And we can do, again, within the process of our planning or portfolio construction for DST, we may want to have a position that has a shorter duration or a shorter holding period. That allows a client to get back to direct real estate sooner. It also allows them the opportunity to start doing some tax planning. So when you sell your direct real estate, you more often than not don't want to take any direct tax consequences. But when you're looking at migrating that full property value into several DST, when those DST come due or exit, you have the opportunity to potentially take a tax impact, but it's a much smaller dollar amount. It's much more manageable. So if you sell a property for $1 million and you put that into 5 subsequent DST for diversification purposes, and then over the holding period, they start to mature, you may, based on your specific plan, decide that components of them will be sold. You will take the tax implications, but it's on a very much smaller dollar amount, not the full million. So we do a lot of planning, again, longer term on what the client's interest is, because it's great to grow that asset. It's great to see the appreciation. But a lot of our clients ultimately, and especially in the retirement years, want to benefit from decades of hard work, putting a lot of time and effort towards upkeep and maintenance of these properties. And it's not just in an income play. They want to generate some assets that they can enjoy their retirement years or that phase or stage of their life. So we help them deconstruct or distribute that portfolio over time.
What other options can you provide for someone who may have a failed exchange or doesn't want to reinvest everything into a replacement property? And I will say that comes up quite a bit from our side of things. We definitely have conversations with clients who initially begin their research on exchanges with a misunderstanding of how to have a fully tax deferred exchange. You basically need to reinvest everything. You can't just reinvest your gain or your equity. You have to reinvest all of it. A lot of people aren't comfortable with that, or they need some cash to use for other things. We also come across people who are selling items that aren't real estate. In 2017, with the Tax Reform Act, they eliminated personal property exchanges, which involved, artwork, collectibles, fleets of cars, things like that. So anything that you might be able to discuss, kind of leading towards the qualified opportunity zones. I am not an expert in that. I have a lot to learn. So if you could just kind of talk high level on what it is and how it can benefit those types of people.
We are approached by clients that had a property fall through. They thought it was a sure thing. They thought it was going to matriculate and they didn't have anything to worry about. And things happen. So they're left with that tax consequence. So a number of years ago, through the Tax and Jobs Act, qualified opportunity zone funds, which is what we utilize in this event where a client misses their 45-day, became a viable investment option for clients. What it allows them to do is to take those gains and defer them by investing in a qualified opportunity zone project. The projects we use, again, are qualified opportunity zone funds. They are securities, so you have to be licensed as a registered representative with a broker-dealer or a registered investment advisor to be able to offer these to clients. They are long-term investments, very similar to real estate or a DST, but the holding period in most cases is going to even exceed your average holding period in a DST of 5 to 7 years. A qualified opportunity zone fund held to maturity to benefit from the tax deferral is going out to 10 years. What we also educate clients about is the fact that qualified opportunity zone funds are based on ground up development. They're not stabilized projects. In most cases, they're not even generating any income whatsoever until several years into the holding period. Because again, a lot of the legislation around qualifying to be a developer in a qualified opportunity zone for a project goes to the fact that you must improve that area, you must improve the site or the development, and ostensibly that's going to be a new project, a new building, and it could be in various sectors. Qualified opportunity zone funds may be blind pool projects where you don't exactly know what they're developing, but they have identified the location. Or it may be a qualified opportunity zone project where they have identified the exact location and or project that clients are looking at. So again, there's a different risk profile that we use when we're talking about qualified opportunity zone funds for clients versus the DST. A 1031 exchange and a qualified opportunity zone investment are not the same. We get that question a lot. Where are they the same? Where they differ? The qualified opportunity zone is going to be the gains, where we know from a 1031 exchange experience, it's going to be the value of that property that's sold. So your, complete replacement value.
And I think one of the issues with the qualified opportunity zone that investors need to be aware of is based on today's date, if they reinvest the taxable gain, it defers the current taxable gain to December 31st, 2026, at which time it becomes taxable. And then they need to hold the new investment for a total of 10 years, so 5 years more. And at that point, at the 10-year point, which you pointed out, that's where it becomes tax-free income. So the tax-free income could be huge, but they do have to realize that at that 5-year mark on December 31st, 2026, that's when the current tax is going to be triggered. And they have to kind of plan and budget for that.
That is exactly correct, Bill. And another point that we make sure clients are aware of, and where that differs from the 1031, where you can continue to defer, the QOZ investment is going to have that realization of taxes at that sort of halfway mark. So if it is a ground up development project that's not generating the type of income that could potentially put proceeds in your pocket to help you offset that tax bill, you're kicking the can down the road, so to speak. And we want clients to be aware of that. So again, going back to the experience that the client's going to have, the right project that based on what the projected development time horizon or timeline is, keeping that in lockstep with what their tax bill is going to be, and then their long-term investment objectives. So it's a lot to consider. And again, in the context of how we work with clients and we plan, we will evaluate whether a qualified opportunity zone fund is a good fit. No one likes to pay taxes, but we also don't like to put clients in a situation where they don't know what the next 5 or 10-year holding period or experience is going to be. And in some cases with blind pool QOZ funds, it's a leap of faith with respect to what's being developed and what that time frame is going to be. I think we all know from being in the real estate business that it's important to work with the right firms in terms of your development partners, the sponsors for these projects. Have they done development in the past? We do a lot of vetting around these solutions. We want to understand not only who the sponsor is, but who are the developers hired by the sponsor. And in some cases, there are going to be multiple developers, even in the same project, because they're going to be working in different sectors and in different areas of the country. So understanding exactly to your point, what the implications are, at the beginning of the investment, whether they're getting income or not, mid-range through, is it going to create a very large tax bill for them? And how are they going to offset that tax consequence with income either generated from the project or some other asset that is available? Because they don't want to put themselves in a situation where they're incurring a taxable event to pay for a taxable event. So we want to be mindful of what the longer term experience is, even when using the qualified opportunity zone funds. There's been a lot of interest in it. It's really done from a environmental and social governance standpoint. It's done wonders for many communities throughout the country. And we have a lot of clients who are invested in doing good by doing well.
Super. This has been a lot of really good information. So really appreciate you joining on our podcast today. It's always great to have that kind of good education for the investors so they can make a better informed investment decision. And as a wrap up, how can investors get in touch with you?
Bill, the best way for listeners to get in touch with a member of Realized is going directly to our website. It's www.realized1031.com. And they can request to set up some time to speak with one of our directors of investment property wealth management. We also have a tremendous amount of resources that we have on the site, educational materials that are available, great resources if you're considering a 1031 exchange, utilizing a Delaware Statutory Trust, an umbrella partnership real estate investment trust, or even materials on the qualified opportunity zone funds that we talked about. So a great resource. And if you want to spend some time talking directly with a member of our team, we are always available. And as you can imagine, we love to talk about 1031 exchanges and Delaware Statutory Trusts. So please feel free to reach out. And telephone number, I'll give you my telephone number, 512-871-0312. And again, I love to talk about all things 1031 exchange. And I just want to thank you, Bill and Lauren and the Exeter team, for having us on today. You are a tremendous partner and a leader in the space. We always hear amazing feedback from our clients when they work with Exeter, and we're proud to consider you a partner. Thank you so much for the time today.
Perfect. And thank you so much for joining us today on Go Ahead Ask Podcast and listening to our content. Our next episode is going to be discussing another tax planning strategy called Charitable Remainder Trust, which not only works with real estate, but with the sale of other assets as well. What are they? How can you benefit from them? And when are they appropriate? So again, thank you for joining us today on Go Ahead Ask Podcast. We always encourage questions and topics, so feel free to email anything you'd like us to cover or any questions you might have to ask at exeterco.com, or call us at 619-239-3091. If you love our podcast, please, again, like it, subscribe to it, share it, and comment on it. We will monitor any comments or questions, and we will ask them. So thank you again for joining us today, and we look forward to having you on our next podcast.
Thank you for listening to Go Ahead Ask with the Exeter Group. Join us for our next episode when we further unravel the mysteries of real estate.